Hey folks, I'm best-selling author of The Power Zero, David McKnight. In today's video, you'll see part 7 of my conversation with CPAs Greg O'Brien and John Malone, in which we discuss whether or not it's too late to protect your retirement savings from the impact of future higher taxes.
You mentioned the importance of trying to keep your Social Security not taxable. And I think that we've talked to people that have that feeling. They're like, hey, like I'm paying in my payroll taxes, I'm paying in my Social Security taxes when I'm in my 20s and 30s and 40s and 50s. What do you mean that I could get taxed on 85% of that later? Haven't I already paid? Like, I think people view that as I've paid this money to the government. Why are they taxing this to me again in the future? Can you talk a little bit about that?
Yeah, I mean, I feel it. It feels like a double tax, right? It felt like a tax when it came out of your check to begin with, and then when you get it back in retirement, it tax you again. So, look, it's one of the things that they've done to keep, back in 1992, I believe it was, Bill Clinton and Tip O'Neill got together and they said, or maybe it might have even been before that. It might have been Ronald Reagan and Tip O'Neill. Social Security was facing this huge insolvency crisis, and they had to do something to sort of shore it up for another set of years. And one of the things that they decided to do is they decided to tax some people's Social Security based on a formula called provisional income. And basically that infusion of cash is what made Social Security solvent, extended the solvency of Social Security. Well, obviously we're coming to the end of that road, right? The Social Security Trust Fund is going bust. So, I give people permission to not enjoy it. It's not an awesome feeling, having what feels like a double tax, but it's one of the things that the federal government has done to shore up Social Security. And it also speaks to the insolvency of these programs. I mean, what do they do with Medicare? I mean, Medicare, they charge you IRMA, and the IRMA is going to go up over time. So 2031, the Medicare Trust Fund goes bust. 2034, Social Security Trust Fund goes bust. We're talking across the board, 22% cuts in these programs if they don't do something between now and then to shore these things up. So, I mean, there's worse things than paying tax on your Social Security, like having your Social Security, paying tax on your Social Security, then having it get cut 22% across the board. I mean, but this is, you pick up both ends of the stick. You reap what you sow. We've promised lavish, entitlements to a huge generation of baby boomers, and the baby boomers didn't have enough children to be able to pay for all of those expenses. And now the chickens are sort of coming home to roost. That's sort of the stark math behind it, sort of a demographic time bomb. But yeah, this is the nature of the beast, unfortunately.
Time that you bring that up, we just got a question there too. So I guess in your opinion, David, you've obviously done a lot of research on this. And I think a lot of times, like, you'll hear these topics come up in the political debates once in a while. They'll say, we're not going to cut entitlements. We're not going to cut entitlements. No one wants to be the guy that cuts them or changes that. But factually speaking, like, what do you think is going to, all the things what do you think is going to happen in the next 20 years when it comes to entitlements like Social Security? Are benefits going to get cut? Are age is going to get changed around?
It'd be a combination of all the above. They're going to raise taxes. They're going to cut the programs for people that are our age and my age and younger. I don't anticipate receiving full Social Security benefits. So I don't think they're going to cut them for baby boomers, because baby boomers are the ones that get all politicians elected, single largest voting bloc in the nation. So I think those people are going to be okay. But if a lot of your listeners and clients are, younger than 50, I would not plan on getting all of your Social Security. Social Security is a relatively easy fix. You push back the retirement age, you cut the benefits for people like you and me. Medicare is the real conundrum. And this is what David Walker says all the time, because Medicare is 5 times more expensive over time than Social Security. So it's not an easy hole to plug. So that's where we're going to have to see massive increases in tax rates, unless they're planning on cutting Social Security in half. I mean, the size of the hole, just to give you an idea, is $239 trillion. That's the underfunding. That means that we would have to have $239 trillion sitting in a bank account today earning treasury rates to be able to deliver on everything that we're required to pay by law, but can't afford to pay. So it's a huge gaping hole in our budget over time. And so people don't like paying what feels like a double tax, but it's only going to get worse.
It's interesting. It's very, very interesting. I think that, it's unfortunate in one hand, but I think the more facts we have, the better. The more the more kind of research education and talking with people like you, the better as well. So as we're going to move, here to conclude, like everyone's at different stages of this, but, how do tell us more about like, how your business works? How do you and your group work with people? And how do people get in contact and talk more about this stuff with you and your team?
Yeah. So, I've got a team of advisors, about 250 advisors across the country. They're Power of Zero advisors, trained, vetted, qualified personally by me. So if somebody feels like they need help with these types of principles, they can go to davidmcknight.com and we'll try to get you connected with a Power of Zero advisor in your neck of the woods. So really that's, I think, probably the best way to help people.
And David, one question that I got was, is it like, is there any time where it's too late? Like if someone's like, they're at 70, 72, like, are they like screwed per se, or is there always time to make things better?
Well, I think there's always time, but I would say that now is always the best time. If you think about it in terms of tax rates will go up like this over time, even if you wait 5 years, 5 years is still better than waiting 10 years when tax rates will be even higher, right? So one of the number one questions I get at the end of my presentations is, Dave, am I too old to get to the 0% tax bracket? And I remember a lady came up to me at the end of one of my presentations and she was old. She says, Dave, now I'm in a really bad mood. I said, why are you in a bad mood? She says, because I got all my money sitting in the tax deferred bucket. I said, let me see if I understand this correctly. You contributed to your tax deferred bucket at a period in time when tax rates were much higher than they are today. You now have this period and you got a deduction of those higher rates for doing so. You now have a historically low period of time in which to take advantage of low tax rates. So that by the time tax rates potentially double over time, you've done all the heavy lifting. You can then take that money out tax free. I said, is that why you're in such a bad mood? And she says, well, gosh, I never really thought about it that way. So we are, so long as we're in this period of historically low tax rates, I think it's time to act. The window of opportunity is closing. So take advantage of these years. I'd say between now and 2030 is the sweet spot for taking advantage of these historically low tax rates.
Very cool. Very cool. And David, one thing I wanted to call out to everyone that's going to be listening, whether live now or on the recordings, is one of the kind of the free resources that you have on davidmcknight.com is that magic number calculator. And I think you kind of touched on the concept of the magic number. But do you mind just kind of going through that? Like, what does the magic number signify? And then the calculator on your site there, what is it kind of driving at?
Yeah, so that calculator basically says, okay, how much money do you have now? At what rate is it likely to grow between now and when you retire? What is the ideal amount of money to have in your tax deferred bucket by the time you retire? And how much, and therefore, what is the magic number? The magic number is how much you would need to shift from tax deferred to tax free between now and when you retire, or whenever your deadline is, right? Call it 2030, to be able to have perfectly reposition all of your assets into the right types of accounts. And so, for example, let's say you got $1 million in your IRA, and the ideal balance to have in your IRA is $350,000, and you want to retire in 2030. So that calculator will tell you how much money you need to shift from tax deferred to tax free by way of a Roth conversion or what have you, to be able to arrive at that ideal balance by the time you hit retirement. So that's what that calculator does. Okay, folks, that was part 7 of my interview with CPAs Greg O'Brien and John Malone. In the next 10 years, I'm looking to put 100,000 Americans on the road to the 0% tax bracket. If you would like some help implementing a balanced, comprehensive approach to tax-free retirement that shields you from the impact of higher taxes, head on over to davidmcknight.com and click on the Connect with an Advisor button. I'm happy to refer you to an advisor in the Power Zero network that has been trained, vetted, and qualified personally by me. If you're a financial professional and want to learn how to become a certified Power Zero advisor, head over to powerzero.com and opt into my free video series. If you have any comments or questions, feel free to drop them into the comment section below. I'll respond to every single one of them personally. And don't forget to click like, subscribe, and the bell so you never miss a video. This is David McKnight. I look forward to seeing you on the next video.